So good evening. So my name is Hoi Xing Jian,
And my name is Lao Hin.
and me and my partner today is going to present on our simulation and credibility theory CBT. So first of all, let's go through the question first. So this is a dual task assignment for me and my partner. We are involved to create a video presentation that demonstrates the application of simulation in the context of the insurance or investment industry. We need to follow the steps to ensure a clear and engaging presentation. First of all, we need to choose a specific aspect of insurance industry that interests us, such as general insurance, life insurance, or investment. And we also need to specify the nature of the business that we will focus on. Next, we need to develop a simulation scenario by using actual data or generating the random data. We need to clearly define a financial challenge or problem within the chosen insurance aspect that our simulation will address. From the fourth point, we need to integrate a simulated client consultation segment into our presentation and explain how our simulation aids in addressing the financial challenge and supporting the decision-making process. We need to demonstrate the application of our simulation results to propose a realistic solution to the financial challenge and describe how our simulation help to solve a real issue that business or clients in the chosen insurance domain they are facing. So I will pass to my partner Lao Yuehin first.
Okay, thank you, Qingjian. So firstly, why are we choosing life insurance? Life insurance plays a crucial role in securing the financial well-being of individuals and their families in the event of death. The decisions made within the life insurance industry carry profound consequences for people's lives, ensuring a measure of financial stability during challenging times. Next, demographic factors like age, income, and family structure play a significant role in shaping the demand for different life insurance products. Examining these demographic dynamics through simulation provides valuable insights into involving market trends and the changing preference of customers over time. Life insurance also introduces complex actuarial challenges involving calculations related to mortality, morbidity, and policyholder behavior. Simulating these actuarial aspects offers a deeper understanding of effective risk management strategies and the dynamic factors that influence the pricing dynamics within the insurance industry. Next slide. There are several nature of life insurance. Firstly, life insurance services primarily focus on providing insurance products designed for a specific needs of young families. These products are crafted to offer financial protection in case the policyholder passes away, ensuring the well-being of the family they leave behind. In the business of life insurance services, the main task involves assessing and underwriting the risks associated with insuring young families. This process includes evaluating factors like the parent's age, number of children, income levels, health conditions, and other pertinent information to determine the right coverage and premiums. Beyond just insurance, the business may also provide financial planning services or work with financial advisors to assist young families in reaching their financial goals. This could involve incorporating life insurance into a broader strategy for financial planning. Next slide. So, from our research, the population of Generation Z, which most of them are young families, have a lower percentage of 44% of population planning to buy life insurance compared to the 50% millennials population planning to buy life insurance. So, why premiums are important to young families? Firstly, life insurance becomes especially important for young families as it serves as a key means of providing financial protection for their dependents. The primary purpose is to create a safety net, particularly in the unfortunate event of the main earner passing away, helping the surviving family members by covering immediate and ongoing expenses. For families relying on the income of one or both parents, life insurance plays a crucial role as an income replacement tool. The death benefit from a life insurance policy steps into replace the lost income, ensuring the family's financial stability and covering necessarily living expenses. Moreover, life insurance can also be instrumental in funding educational expenses for children. This encompasses covering the cost of primary, secondary, and higher education. By doing so, life insurance helps young families realize their financial goals and aspirations for their children, even in the absence of a parent. Next slide. So, there are several financial challenges from the life insurance for young families. One of the challenges in the insurance industry is to set the right insurance price, as we need to find a balance. This means figuring out how much coverage is needed if something unexpected happens, like a death. It's important to set a price or premium that fairly represents the risk linked to young families. We also have to consider another thing, which is finding the right balance between giving really good coverage and understanding that young families might not have a lot of money to spend. So it's about making sure the coverage is good enough while keeping in mind the financial limits of these families. Next, I'll pass to Xingjian.
All right, thank you, Yuehin. So I will go through our simulation part by using Excel. So first of all, I would like to say that our presentation, our simulated scenario is based on whole life insurance policy. The data points that we decided to generate are 1,000 data points. We have generated 1,000 data for both husband, wife, and children. Is because we think that it will be more accurate for our premium calculations based on the random generated data within the range of age, the range of income, and health status that we fix. Besides that, the size of our data is also based on the complexity of our aspect and financial challenges, which is the first challenge, determine the appropriate premium for young families. Based on research, young families' age range is within 21 years old to 35 years old, and we set their income is based on the age. For example, the income of male for 23 years old. If the age is less than 30, we generated the random data monthly income from 2,000 ringgit to 4,000 ringgit per month. And if the age of the husband is in between 30 to 35 years old, we will random generated the their monthly income as 4,000 ringgit to 6,000 ringgit per month. We assume that their income range is 2,000 to 4,000 and 4,000 to 6,000 per month based on different age range. This assumption is more realistic on current economic situation. With these conditions, we think that 1,000 data point is sufficient since the age range is only 15 years to consider, from 21 years old to 35 years old. For the calculation part, we need to determine the appropriate premium for young family client. We decided to use random generated data to perform our calculations. First of all, we random generated 1,000 male and females age from 21 years old to 35 years old by using the rand between code 21 to 35. And the monthly income, as I said just now, is based on the age. We also use the rand between code. And also the health score. We also use the rand between code from 1 to 10. 1 is being unhealthiest and the 10 is being healthiest in this case. After that, we need to consider the risk score to calculate the insurance coverage benefit for the clients. For the risk score, it's basically based on 40% of age, 30% of monthly income, and 30% of health status. The weightage is basically determined by us since we think that age is the main factor to consider because it could majority impact the benefit coverage value. Why we saying that? Is because our benefits is determined by multiplying annual salary with the year until retirement for each male and female. For example, when the age of husband is 23 years old, we set that the retirement age is 65 years old. So the number of year until retirement is 42 years. And the annual income is basically 12 minus the monthly income. So that our coverage requirement is basically the annual income of male multiply the number of year until retirement, which is 28,764 multiplied with 42. But we need to also consider the the children additional coverage. Why is that? Based on the research, one additional child will need additional coverage for 100,000 ringgit for a family. In our case, we divide that value to 2. We divide 2 and separately divided to each husband and wife based on the code. For example, in this case, they got 3 children. So the additional coverage is 300,000 and we divide 2 so that the male coverage requirement is annual income multiplied with number of year until retirement. We need to plus additional 150,000. After we got the coverage requirement benefit for each families, we need to determine their premium needed to pay. For the premium calculation, we use the death benefit multiplied with the risk score that we calculated just now and divided by the present value factor. What's the present value factor? It's basically 1 plus the interest rate power by the number of year. And since it's whole life policy, we assume that 60 years is enough for their whole life because the minimum age for them is 21 years old. For the interest rate, we fix it at 6%, which also we determine by ourselves. After that, we sum up the premium for the families for male and also female. The calculation for male and female is the same for everything to become total premium. And then And we also need to determine their premium needed to pay yearly by dividing to 60 years. So in this column, in the Z column, you could see that for the whole life insurance yearly for a family, for the first couple, they need 27,596 ringgit per year. They need to pay the premium. After that, for the client consultation segment, this part, we do this by using the VBA code, by using a lot of if else and also the random assign variables. How it functions. For a client, they could insert the age, the demographic status, demographic information. For example, for husband, the age is, let's say, 34 years old. The wife, let's say, is 28 years old. And the monthly income for the husband, let's assume it as 4,300. For wife, we assume that 3,300 per month. They also need to insert their health status. For example, smoking. For husband, he smoked. For wife, she didn't. And the number of disease, diabetes, cancer, etc. For husband, he got two diseases. And for wife, she only got one. And the most important thing is for the number of children to calculate the additional coverage needed. Let's say one number of children. So after that, we click this button, generate premium. They will know the coverage provided for whole life is total how much. In this case, 3164800. And the premium yearly for the whole life means that this is the yearly premium they need to pay for a families. Then they need to pay is 23,705 ringgit per year. Besides, we also generated their total income, the monthly premium, and the income percentage that used for them that pay for the family life insurance per month. As the diagram show, they spend around 26% of their income to pay for the premium. We have simulated many times. The income percentage for family life insurance per month is basically around 21% to 27%. The income percentage that used for family life insurance might be too high or too low for different individuals or families based on their financial situations. The key insights of this simulation scenario is that it could help the insurance company, especially life insurance companies, and also young families client to have a better and clearer understanding of how much coverage and premium should be considered when different scenarios came out, such as different age, health status, income level, etc. Besides, we think that the result could be applied in current life insurance market for both underwriter and pricing department to have a clear direction on how to work with the premium which would be affected by these factors, which is age, health, and also income. So I will pass back to Yue Hin now.
Okay, thank you, Qingjian. So, as Qingjian mentioned just now, the first financial challenge, which is determining appropriate premium that provide sufficient coverage in the event of unexpected death, has been solved. For the other two financial challenges mentioned previously, there are also solutions for them. For the risk assessment and pricing one, we could create a strong risk assessment models that think about things like how steady the income is and the health history of the family. And for the affordability of young families, we could create insurance plans that can change and fit different income levels and financial situations. Next slide. So for the limitation part, firstly, we didn't change the interest rate while simulating the data, which was mentioned by Qingjian just now. Our interest rate is constantly fixed at 6%. And then families with income that below 2,000 ringgit or above 6,000 ringgit, we will not be considering them. And for the number of children for each family, we will only consider families with a maximum of 3 children. So like families like 4 or 5 children, we will not considering them. And from our outcome, young families are only be able to see a clear picture of premium needed when buying whole life insurance, but not term life insurance, not endowment, or not other insurance, as we are only focusing on whole life insurance. Finally, we will also not be considering occupation factors such as high risk or low risk occupations. So this is our CBT presentation. Thank you.
Yeah, I hope that you all enjoy our presentation and understand what we really do for our simulation assignment, and not only assignment, what we contributed to the life insurance industry, especially for young families, and how to calculate the premium, everything. Thank you.